we're not exaggerating that when it comes to voices on Wall Street, this is the one everybody globally really listens to.
Yeah, without a doubt. He's the dean of Wall Street CEOs. He's been in that seat for almost 20 years and looks like he'll be there for at least another year or two or more. So when you look across the landscape, it's very hard to find someone with that level of longevity. And then you have to remind yourself that he's at the helm of the nation's largest bank. So that magnifies the weight of his voice.
So anything he said that you found interesting ahead of earnings next week?
Before we get into the earnings part, I will say I was quite fascinated by some of his commentary around AI, because this is a question we like to ask all bank executives. Can you put a number on it? Can you tell us what the savings are? And for the last several months, the answer we've been getting from a number of these folks has been, there have been obvious productivity gains. You know, easiest to quantify will be an engineer can code 40% faster, or you can do, you can very specifically drill down on that front, and you can save time. But they've all been struggling to put a real number on it. They've been struggling to tell investors and analysts that come 2026, I will be able to reduce $500 million in costs or $1 billion in costs. So it was very interesting to hear Jamie talk about it. Of course, I think when he's talking about AI, he's taking a little bit more of a broader lens, not the post-chat GPT perplexity world of AI, but even going back to 2012. So I'm assuming he's talking about this idea of increased adoption of automation.
Which banks have been doing for a long time. Banks have been doing
for quite a long time. And in his case, he says JPM has been using some form of AI since 2012. But he did say in that period, we are seeing roughly $2 billion in cost savings. So we're spending $2 billion in AI, and we're seeing that cost savings. So at least he's able to justify it to his board, his investors, his analysts, that there could potentially be more savings ahead. But we're already seeing enough to convince us that we can continue spending at this level, and it's all a net positive for JPMorgan. That was fascinating for me.
Yeah, for $2 billion expense, we have about $2 billion of cost savings for AI. But he also said it's the tip of the iceberg, and that JPMorgan is getting better at AI. What does he mean when he says it's the tip of the iceberg? Is that from the way they're using it internally? Is it from what customers are going to see? Is it everything? I mean, what's the vision that banking executives have for this technology?
So, and again, we have to guess a little bit here, but we have to assume as a large consumer bank, as a large retail bank, the places where you can obviously see the obvious impact is customer service in detecting fraud, in handling queries and complaints and whatnot. But you can take it beyond that into the kinds of things that will take it beyond the realm of simple customer service issues, into how it can aid traders, into how it can aid investment bankers. And therefore, it could perhaps in aspects of asset management and wealth management, at which point it touches every large segment of JPMorgan. So the benefits that they're already seeing in the retail banking segment could expand well beyond that into every other part of JPMorgan. And that's when you see this $2 billion of cost savings that he touts, a number that could go much larger than that and will keep him happy to continue investing in this space.
How do you take, I mean, he said a lot of merger talk, firepower in the market, and I know maybe not everything was in that interview, and I highly recommend people check it out on the Bloomberg for the entirety or the entire interview. But he also talked about consumers okay now, but recession could happen in 2026. But again, he seemed like, yeah, it'll be okay. Is that again like a reminder there's the K-shaped economy for a recession's going to hurt some people, and maybe more so than
it's a little bit of also which side of the bed does Jamie Dimon get out of, because there are some interviews where he does sound like the weatherman warning about the dark clouds on the horizon. And there are other interviews where he will like to stress the fact, whatever happens in the economy, we, Fortress JPMorgan, are going to be completely fine, which is why I found his statement funny when he said, when he was asked about, are you worried about a recession? And no. So, when our anchor asked him, so does that mean there's no recession? He said, no, there could well be a recession in 2026. I'm just saying I won't be worried about it because I'm prepared to deal with it. Two different statements.
Bank earnings next week. We like to hear from these banks quarterly. I can speak to that as a journalist, as a broadcaster. Are we going to keep hearing from them quarterly?
Jamie actually addressed that point, and I guess you're referencing this push by President Trump to say we need to move away from quarterly earnings. We perhaps make it every 6 months because it has become too cumbersome. Jamie, the way he addressed it, he said, look, we'll probably still give quarterly updates to our investors, perhaps not with that level of detail. But I think it would be fascinating for anyone to listen to that full clip, because he did hit on some very critical issues. He says, in the last 30 years, the number of public companies has actually gone down. We've gone from 8,000 public companies to 4,000 public companies. A lot of this perhaps has to do with the fact that in the pre-IPO stage, the amount of funding and financing that's available to companies makes it easier for them to stay private for longer. But he also adds to the fact that there are just onerous requirements of public companies that makes planning for the long term hard. And he was very specific about it, because when a CFO goes on an earning call and gives you guidance, gives you an estimate, Jamie Dimon actually took us behind the scenes to tell us what happens when you float a number like that. Then you're spending the next 12 weeks making sure that you're going to hit your mark, because you don't want a black eye in the market when you come for your next earnings call, which will make you do some stupid things, which will make you want to move some resources from one side to another. Let's say you come out with an NII estimate and you're not meeting it 6 weeks into the quarter. You want to shift more resources towards making sure you meet that NII target, even if that's not the best use of the company capital allocation.
All I would say is an environment where we look at OpenAI, right? And what is it, $500 billion potential in terms of its market valuation, so much money floating in, out, all around that company. It's not public, and we really don't know everything behind the scenes when it comes to its financials.
And that's why company management will tell you we'd like to have it exactly that way. Listen to our advertising touts, not drill into our numbers.